I'm Jordan Hucht with Vision Wealth Partners, and today we're going to talk about the concept of behavioral finance and its impact on financial decision-making and outcomes. First, let's understand what behavioral finance is. Essentially, behavioral finance refers to the role that psychology plays in influencing financial decision-making, specifically in this video with regard to investment decisions. The reason that so many people, especially otherwise very successful people, are poor investors is that they lack the introspection required to make sound decisions that at the time seem to violate their emotional intuition. In other words, they hurt themselves by letting emotion and human nature drive their decision-making process. Let's look at a few of the most common behavioral finance-related mistakes that investors make. First, and perhaps the most common, is focusing too much on the very short term. Investing is a long-term game. Real wealth is created by making consistent, prudent decisions and having the patience and discipline to reap the long-term rewards. But winning over the long term comes with losing in the short term many times along the way. Emotions are highest when values are falling, so doing the right things in those moments can sometimes feel all wrong. Next, one that we've seen over and over again throughout history. Making an investment because it seems like everyone else is doing it and making a lot of money and you don't want to miss out. This has happened countless times in the past. The Dutch tulip mania of the 1600s, the South Sea bubble in the 1700s, and more recently, the dot-com bubble at the turn of the century, or even some meme stocks in the last few years. In all of these cases, investors rush to get in at any cost, driving the price up parabolically while leaving discipline and reason in the dust. Sometimes referred to as greater fool investments, the only hope for gain is that someone else will pay an even more unreasonable price than you did. Untethered to any semblance of intrinsic or fundamental value, the collapse eventually comes and a lot of money is lost. On a similar note, but to a much lesser extreme, investors oftentimes focus way too much on trying to hit home runs or investments with huge returns. I can't tell you how often I see this. People think they're going to make a bunch of money by picking just a few stocks that will have huge returns. The reality is that's just not practical. When you're swinging for the fences all the time, sure, you'll probably hit a few, but you're also going to miss a ton. And the reality is you're almost surely going to end up with inferior overall results. There's a reason that the average investor dramatically underperforms the overall market. I tell clients all the time, there's a place for speculation within a portfolio, but it's got to be a calculated risk, and the core of the portfolio needs to be comprised of disciplined, thoughtful investments. And finally, one of the hardest mistakes to overcome, the inability to admit you've made a mistake. No matter what, there will be times when you've made an investment decision for all the right reasons, but it doesn't work out. It happens. But over and over, the mistake gets compounded because investors don't want to accept that they've made a mistake and keep holding on because they're emotionally invested in the hope that the investment will work out, and they want to believe that they were right. One of the hardest things to do is to know when to cut your losses and move on. Perhaps the most challenging part of being a successful investor is having the self-awareness to realize when your emotions or aversions or personal biases are clouding your judgment and tempting you to make poor decisions. Investing doesn't have to be overly complex to be successful, but it has to be disciplined.